Hi, Sam. Nice to meet you finally. Congratulations on all the work you've been doing. How are you?
I'm good, good. Crypto's been busy again. Trading's been taking up a lot of my time again, but always fun when this happens, so I don't mind.
Well, my one of my producers, Danny, is a huge fan of yours. Usually, I pick all the guests, but he's been nagging me for a while, saying, "You need to get Sam on. You need to get Sam on." So we got to thank Danny for this.
Well, yeah, thank you, Danny.
All right, listen, I've got a lot I want to ask you about. I'm not a trader, just for context, because I'm shit at it. I will buy spot and I do hold, and like maybe 3 or 4 times during this bull market, I've gone out and bought because I felt like it's been a good buying time. But I'm not a trader. I have plenty of traders who listen to the show, both successful and terrible traders because they email me. So I've got a lot of questions to work through with you. Um, but just as a starting point, it's always good to intro new guests who haven't been on the show before. Do you want to just tell people a little bit about yourself and what it is you do now?
Yeah, so growing up, I was always one of those math kids who did like math competitions and stuff. Um, and yeah, so I was doing that like all throughout high school, and then went to college for math and computer science. Um, Sam Bankman-Fried, the founder of Alameda and FTX, and I went to the same math camp during high school, and then we also went to MIT at the same time. So that's how I know him. And then after graduating, at this point I'm still not into crypto. But after graduating, I was did a trading internship during college um, at like quant trading firm called Susquehanna in the U.S. And went back after graduating. I was doing quant trading there in more traditional assets like bond ETF arbitrage, things like that. And I was also working on their sports desk, like sports betting. Um, and but like around like a few years in, I sort of started realizing these things about the crypto market that were like looked kind of insane from the perspective of someone from a quant trading background. This is like 2017 or so, and you would see things like Bitcoin's trading like 1% or 2 apart on like the two biggest spot exchanges in the U.S. And it turns out it's not just a data error. You could actually like buy on the cheap one and send it to the rich one and like just sort of lock that in for like real size. It was kind of like just sort of shocking to me. Um, and so I left and worked on this sort of stuff in my personal trading for a while. Eventually, and I moved to San Francisco just because I wanted to, which is where Sam Bankman-Fried was working on Alameda at the time. I got to talk to him at some point. Yeah, just sort of joined. And yeah, have been at Alameda ever since. We Alameda's at this point basically the biggest quant trading firm in the space. We're trading every liquid market on every big like real exchange, I guess. And we're a 24/7 operation, like market making on most of the exchanges as well for various projects and for various reasons. All of our trading's like basically 100% automated. Like we don't touch exchange websites, so we're only using the API in our internal tools. My personal focus recently became the co-CEO. I focus a lot on risk management and stuff, and sort of like broader strategy development. But when trading's quite busy, I'll be in the trenches with everyone else.
So tell me about math camp. Is that like football camp but for math? Is it exactly what I imagine it would be?
Kind of. Yeah, you do like 8 hours of math a day. Uh, it's basically intended to like introduce high school kids to college level math. So
Mhm.
you'll do things like linear algebra, like that, analysis, things you typically only start seeing during a math undergrad. You'll get a taste of during high school.
That's one. Okay, so quant trading is not something I completely understand. It's been explained to me a few times by my friend Travis Kling over at Ikigai, and I still don't understand it. So, can you explain quant trading for me and the people who are listening?
Yeah, sure. So quant trade, like normal trading, or like what most people will be doing if they're doing any trading, is picking a time that they want to like just buy something they want to buy. Like maybe you decide you want to buy Bitcoin if it gets below X price, and so you like do it, and you'll maybe do like I get most like 4 or 5 of these like kind of big trades per month or something like that. In quant trading, instead of generally we're doing like millions of trades every single day, and the impetus is for those trades like obviously have to have like a much lower bar. We can't have like a million great reasons we want to do a trade every day. Um, so what we're really doing on some level is we're saving a bunch of data. Like we every time like every coin moves, we save the price, we save the timestamp, we save like all these things for every product in the world basically, and we run these like sometimes fairly intense studies on okay if we always bought Bitcoin every time like this small thing happens, like every time the premium of this future got above the premium of this other future, like what would happen? And like most of the time, like these studies will yield like, oh, you'll probably lose money. But sometimes the studies will tell us, oh, yes, like this actually does make sense on average. If you do this, uh, if you do this like every single time it happens, like if it happens like 1,000 times a day, if you do it every single time, then on average you will make money. And that's the kind of thing we're always looking for. We're looking for these like these strategies that we can automate and just sort of make money with all the time. That's sort of like a that's like that's an example of what one class of things we're doing, I guess. We're also doing other things, um, like for various like exchanges and for various projects in the past. So we've made agreements to market make, uh, which sort of means that we agree with them about size and width. And once we've agreed on those, we just sort of like are always making markets of that size at that width on like various order books. It's like fairly well known at this point that we're a primary market maker for FTX. Every time FTX lists a new market, we're providing liquidity there and also their old markets. Um, and we're able to do that because like part of what we've built in becoming such a big quant trading firm is the infrastructure that allows us to be making 24/7 quotes, like updating them very quickly in response to in response to like changes in prices very quickly, and that sort of goes hand in hand with a market making business, which we've also been able to build out.
Right, I'm going to come back to market making because I want to ask about that separately. So, but on the quant side, so you're really looking for patterns, profitable patterns to take advantage of. Um, that's how much of that is like automated versus decisions being made by humans.
Right. Yeah. So crypto is like it's been around for a while. It's gotten more mature, I think, on some level, and the yeah trading has gotten like in some ways has gotten fairly predictable. Something I talk about on Twitter a lot is our trading around liquidations, and the ways in which that's sort of gotten predictable. So for some brief background, like the crypto trading world has more liquidations, especially public liquidations, than you'll see like literally anywhere else in the world. Um, that's enabled because of the way crypto's margin structures work, where exchanges sort of let you get really high leverage, and then there are means of calling you on that leverage if your position goes against you is just by sort of sending a market order into the market, and like this can like cause all kinds of like short-term price movements that you wouldn't otherwise expect, and the exchanges like sort of tell you about it. They tell you like, oh, this is a liquidation order, or some of them do, but enough of them do that like you can like really like do pretty cool things around this, and for a while this was something we did quite manually. We would get like alerts that like a bunch of liquidations are starting, and like I would just sort of like watch the order books and like be able to tell when they were going to be over. And it turns out that like because the liquidations are very aggressive because they're sort of like sending market orders into the order book, you always want to trade against them. And so when there'd be like a bunch of short positions getting liquidated, you it would always cause like a big peak that would go right back down, and so you want to sell into the peak, and vice versa. And that's for a while, yeah, that's something I was doing manually. It's gotten predictable enough that we've been able to automate it, and that's sort of the pattern that always happens uh, with our best trading strategies. We're like we have a team of traders who's always watching the markets. We feel that we start to understand things that we are trading manually, and then once they like sort of happen often enough, and we're able to automate it, then that's what we do.
Yeah, so SPF talked about this recently. He put out a tweet thread talking about leverage in the system and that. And also, I talked to one of my trader friends, Willie Woo, who you probably know very well, but he talks
Mm-hmm.
about most of the time he's not trading anything beyond like 1.5 up to max 3 leverage, depending on market conditions. Yeah, a lot of these exchanges are offering 10, 25, 100. I think even think did Binance offer 125 at one point, and maybe it still does.
That's right.
Something also that I think where I'm in the UK that the FCA have cracked down upon. What's your kind of view on this? Do you think there shouldn't be any moral authority over how much leverage there is, or do you think there is some responsibility around that?
Right. This like as like an experiment. Like imagine that you're gonna put on some like 100x levered long position, uh, and this isn't quite right just because the calculation is a little bit off because like there's like initial margin conditions that you have to think about. But let's pretend that that means that if your position goes 1% against you, then you get liquidated. It's not again that's
Hmm.
not quite right, but it's very close. Um, and so basically this means and so like if you look at like any crypto graph, like look at Bitcoin's graph today. It always moves 1%. Like there aren't days where it doesn't move at 1% in at least one of the directions. Usually both. And So if you're putting on this 100x long position, you have to be like really sure that it's not going to go down 1% before it does anything else. And it turns out that like no, it's impossible to be that sure. Like if you're that sure, if like it, I think that I've been that confident about a trade like a crypto trade, like maybe like 2% of the time ever. Crypto is just so volatile. Bitcoin is so volatile that like you're just gonna see these like 1% moves in either direction, like way too often for this 100x levered long position to make sense. Because like yes, like you can say that it's zero. Like if we just think it's coin flips, like there's no like if we think it's coin flips, but you're buying, so obviously you think it's good to buy. Uh, so it's not like we're like sure it's going to go down, but when it does go down, you get liquidated, and liquidations are like way worse than sort of anything because they market order you into the order book without any regard to price. And that's just going to cost you way too much money when it happens for this trade to make sense on average. So like yeah, like sometimes like it'll go up it'll never go down, and it'll go up, and so like you'll have 100x to what you would have made if you hadn't levered up. But the times when it does go down just cost you so much that if you do this trade like 100 times, you're just going to lose way too much on average because of the cost of liquidations. So it's not like I think there's like a moral reason or that this shouldn't be allowed, but like no one should do this. Like if you're trying to make money, it's just a bad idea. And like to the extent that people do it anyway, like yeah, it's plausible someone has some responsibility to be regulating it, but uh, personally, I think it should be regulated by the people who don't want to lose money. But
Yeah, that's fair. I mean, I know you work for Alameda Research, but you do have the relationship with FTX. Do you know what maximum leverage they offer?
yeah, so they just recently start reduced their maximum leverage, I believe, to 20x from 100x, just sort of in keeping with this idea that this doesn't actually make sense for anyone.
But that's quite a good thing for them to do because that's them considering their users.
Yeah, that's right.
That's putting their users ahead of themselves.
Yeah, on some level. Um, I don't. I'm not super privy to the decision making thinking or whatever.
Yeah.
But yeah, I think that it makes a lot of sense. Yeah, like obviously to first order, it benefits users because it like stops them from getting liquidated when they might have otherwise. But like to second order, like let's say that that can persist for a while, and like other exchanges have more liquidations than FTX does, and their users like start getting upset at them. It's pretty plausibly good for the exchange as well, I think.
Yeah, okay. Let's talk about market making as well, because this is something that people ask a lot about as well, and also find quite difficult to understand. Sometimes it feels like a little bit of a murky place. But I mean, again, it's another one of those things. It's been explained to me a bunch of times, but I don't really understand it. Can you explain how it works, what the role of a market maker is? Because I've also seen it before, like if a new coin comes to the market, someone will offer to market make on behalf of that coin, but sometimes there's like a payment or a premium to support that. And I don't fully understand it.
Sure. Yeah. So the actual mechanics of it are basically like Alameda has these bots that can be putting out orders all the time, 24/7, with whatever specifications that we want. Some of those specifications are we can say, oh, we want like 5 bitcoins out within 20 bips of the best bid and offer. We want 15 bitcoins out within 1% of the best bid and offer, and like we just whenever the market moves, we move those orders as well. And so what that does is the main reasoning behind wanting it is generally like bootstrapping liquidity on new markets or for new projects. So this might be something that an exchange wants, for instance, uh, because like exchanges, like the value add that an exchange might have versus its competitors is that it has like this guaranteed liquidity all the time. And it's like you can they can make claims like, oh, if you want liquidity, you can always get it here in like this entire class of products. So that's like one set like reason that this might make sense. Another reason it might make sense is for the projects themselves. So yeah, like you just mentioned, when new coins pop up, they might like secure an exchange listing. But like generally, being a successful crypto project and having a token that's getting listed on some exchange doesn't really correlate with like having the capacity to have orders out all the time. It's like a quite specialized skill. And so yeah, often they'll go to a firm like Alameda that has market making capacity and give them some incentive to be market making all the time. In general, the incentives, at least the ones that we've tended to want, are not really like a cash payment or anything like that. We'll basically just want to be allowed in on their most recent investing round or something like that. It sort of aligns incentives a lot better, just because we'd much rather just like want their project to succeed at the same time that we're helping it to succeed by market making. And so like just getting along their project makes a lot of sense. It also is sort of necessary on some level, because if like let's say that we're market making like token X, that means we're placing bids and offers out. In general, if the if there are like net buyers, we'll end up net selling, and like at some point we'll have to like deliver tokens when the buyer withdraws. So it generally helps for us to have bought them beforehand in order to like be allowed to sell in that sense. But yeah, so that's the gist of the entire business, I think. We're just leveraging our capacity to have orders out all the time, versus like various people who have incentive to want orders out all the time.
Can a market maker ever end up in a situation where they're essentially holding the bag themselves?
Not if they've done it correctly, I guess. Because in general, like I think most exchanges are not going to let you place out offers, like for coins that you didn't like deposit yourself or buy or like borrow from a margin lending platform on their exchange itself. Uh, so it's generally not going to be super possible for you to like have sold tokens that you didn't have. One thing that like I've at least heard of is market making agreements where the project, instead of selling the tokens to the market maker, loaned them to them. And that is a situation where like like the market maker might end up screwed if they like have to buy them back after selling them after, because like presumably the price has then gone up, so they're kind of just screwed. But that would sort of constitute a large mistake on the market maker's behalf, and an experienced market maker wouldn't end up in that spot, I don't think.
What's the risk then to market makers, or is it a no risk business if you know what you're doing?
It's kind of no risk, yeah. I mean, you can certainly make it riskier if you feel like it. Uh, like so, Alameda has entered into agreements like the one I just described with the loans, with one important change, which is that we also had options on the tokens as the price went up. So the problem with the structure I described is that the price goes up. We've net sold, and so now we have to buy back to process withdrawals or like pay back a loan or something. And so that like we sold at lower prices and have to buy at higher ones. If we have options the entire way up, then we are like, yes, we've net sold as the price went up, but we also had options to buy as the price went up from the project, and are able to just like sort of buy that and pay the loans back with that. Um, and that is like a slightly riskier situation, just because like there can be like sort of momentary price movements that are out of line with that make us sell like too much at low price levels,
Right.
or something like that. But it's like still like we'll still make money on average doing this, so we're okay with it. In general, it's quite riskless though, especially the like the simpler structures that I described, where you're sort of just getting paid to make orders that like your bots sort of can do sort of for free anyway.
Can market makers push price around at all? Can they push price up, push price down?
Uh, Anyone who like owns enough tokens relative to liquidity, just in sort of in general, can do that if they feel like it. Uh, this is another thing where if Alameda were consistently doing something like that, like, oh, like we have a bunch of these tokens, let's move the let's like remove all of our offers like a couple times a day, that sort of like forces the price up because there's like no one to sell anymore. So like, yes, we could do that. We never would. We found our market making agreements to be pretty profitable for us. If we got a reputation for doing that, we would lose all future flow. So like, yeah, we might make a little bit of money once, but no project would ever want to use us again. And that would be pretty costly for us in the long run. So like, I guess the answer is yes, market makers can do that, but in general, they don't have incentive to.
Right, because again, something I don't not fully understanding market making, but I just wonder if there's ever kind of like a conflict of interest owning tokens or having an interest in a project, but also market making for it. Can you push the price around and increase the net value of the tokens you hold? I mean, you might not do it, but maybe other, slightly more nefarious market makers might be able to do such a thing.
It's possible. Yeah, I'm not going to say it's not possible. But yeah, again, that's sort of just true for anyone who owns a bunch of the token. Like, let's say that I have, or like even as much of money. Like, if I have a bunch of money and I feel like shooting the price of some low market cap coin up, I can. I agree that what you described with owning a bunch of the token gives you the incentive. But yeah, so like it's not like this is impossible for me to imagine. But like I said, Alameda has no incentive to do this, so we wouldn't.
It's funny listening to you talk about this. Is you're obviously very passionate about it, and you moved on from Susquehanna, like one of the biggest firms there is. Like, what was the incentive to move on? Was it just the excitement of the crypto market, or was it more because you recognize so much opportunities, like you mentioned earlier with the arbitrage?
Yeah, if I'm being honest, it was all opportunity to make money. I wouldn't. I didn't even really. It took. I think I was probably not long Bitcoin for an embarrassingly long time. Even after I was like focusing full time on Bitcoin, um, I didn't really have any strong opinions about like the technology or like whether crypto made sense or was the future or anything like that. I sort of acquired that along the way, but I didn't have that for a long time. I really was just like noticing arbitrages and finding it irresponsible not to be focusing on it when I could be making more money doing that than anything else I was aware of.
So you spotted your crypto money printer. I mean, I would have done the same if I had the same skills as you. But so, has your view changed then on Bitcoin? Are you more into the technology and what it brings, and what maybe some of the maxis debate about on Twitter?
It definitely has started feeling more plausible to me that like crypto in various forms and Bitcoin will form a lot of the future of finance. I guess this isn't something I'm an expert on at all. Like I don't really understand a lot of the technology beyond like what people think about it. Because from the perspective of a trader, it matters a lot more what people think than like what is actually going on. And so I understand that stuff. But yeah, I don't exactly understand the technology. I do, like I said, I do believe that this has like a huge chance of being a big part of the future, and I think that's been reflected in like how excited people have gotten about it. The sort of large institutions that have become much more interested in crypto and Bitcoin, and yeah, I think we'll like to continue seeing that. But it's exciting to see the world sort of deciding its opinion about these things. Like even like as we speak, sort of the Senate is talking about this, which is really cool.
Yeah. Well, you've obviously got a lot of experience with traditional markets as well. And you've talked about Bitcoin itself, even amongst a sea of crypto projects being highly volatile and lots of opportunity there. Do you see a scenario where Bitcoin becomes less volatile? Does more liquidity change things? Because I know a lot of Bitcoiners defend the volatility. We're bootstrapping a brand new monetary technology from zero to, we hit $1 trillion market cap at one point. Is there a time where we get more stability, or do you think this is just the way it is?
Yeah, so I definitely think like I think we've already seen this start happening. Like the market becoming more stable. Like I think it would be like to use like the most recent example of like a hugely unstable event. Like March 12th, 2020, saw the market crash like sort of below 4K from starting like around like 8 or 9K or something like that. And this was like the crash itself like made a lot of sense. It was in direct response to the stock market crashing because of like sort of people deciding COVID was like actually happening. But Bitcoin fell way more than the stock market did. And the biggest reason that happened, there's a few reasons why it happened, but the biggest reason is the effect that I was just talking about earlier with liquidations. Because so many people were allowed to be like really levered up and like levered long in particular on that day, when the market started crashing, a lot of these positions started going bankrupt. The biggest place it was happening on that day was BitMEX, so we'll talk about that. The Like a lot of people were like levered long on BitMEX, and because Bitcoin fell from 9K to 7K, and maybe that was the organic part, maybe that was the part that was actually mirroring the stock market. But that's like a 20% drop, and so anyone who was 5x levered or more is like getting liquidated now, and so that sort of and like I mentioned, the way that's mechanicked is the exchange BitMEX in this case sends market sales into the order book for all of those positions that went bankrupt. And that drives the price down even more. So maybe that drove the price from 7 to 6K. And that's another 10%. That liquidates a bunch more people, sending even more market sales into the order book. And this sort of just keeps happening and happening. And with a big enough move, which is what we had on March 12th, this can actually just go infinite on some level. Because if every liquidation order triggers more liquidations than the size of that order, this actually will keep going forever until everyone is liquidated. And yeah, that's what we would have seen. Like Bitcoin fell below 4K, which is like a super inorganic level. No one wanted to sell it that low, but they were forced to. And yeah, BitMEX then went down for 45 minutes
Mm.
and wasn't allowed to process any more liquidations. And then it sort of came back up, and Bitcoin was at 5K or something, and now they didn't need to. So yeah, on some level, like if that hadn't happened, Bitcoin might have printed at zero on BitMEX. We'll sort of never know. But yeah, this is the sort of thing that this is the kind of effect that produces the instability that you're talking about. Like the high leverage and like sort of low liquidity relative to the open interest of the contracts that are being opened up. And yeah, so I definitely think that we're moving to a place where this is less likely. Exchanges taking steps like FTX did, where like higher leverage is like less allowed. The market sort of itself starting to understand this a bit. Like over the past year or something, we've seen a large shift in like open interest of derivatives contracts to open interest in like leveraged spot uh, on exchanges that offer spot margin. And in itself, that's not like a huge thing, but it happens that spot margin in general sees much lower leverage than derivatives does. And yeah, just any move to lower leverage is going to decrease this short-term instability that we see in Bitcoin's price. Because it's worth noting, like the short-term instability is really what matters. Long-term, yes, Bitcoin's price is moving. In general, it's moving up for the most part, or at least it has been historically. The short-term moves where sometimes it goes up 20%, then down 20% the next week. Like that's driven by the leverage, I think, more than anything. And that's the thing that I think people are talking about when they mention that Bitcoin's price instability is like negative or bad. And that is the kind of thing I think we'll see less.
So that's really useful to understand. And I guess there's only so many times that people can get liquidated, right? If it has to naturally evolve to a place where, because like if you're a retail investor and you keep getting liquidated, essentially you're really a gambler, and there's only so long you can gamble. And even if you're a big institution, you get liquidated. So does the market naturally react? And I guess what the question I'll be asking is, and I'm going to come back to your 29K call, but we've moved up quite nicely from 29 to about 46K. Are you seeing a massive load up of leverage, or are you seeing something slightly different this time?
Right. So yeah, I'll address that in a few pieces. One, so yeah, that's another big effect here is that like over time, like you said, the high leverage traders are in effect gamblers, and I mentioned earlier that the person who's doing the 100x leverage thing 100 times, eventually they're just going to have lost so much money from doing that, and this like a larger version of that effect is that the people who keep doing this like do just sort of have to stop trading at some point, or at the very least they have to stop doing that, because yeah, like they're just going to lose all their money at some point, and or just become so like disillusioned with the entire idea that they just stop. So that's definitely an effect we have seen. The market has shifted away from people like that toward people who are using lower leverage or no leverage at all. And that's so that's sort of been one organic effect. In addition, like over the past year, like one of the prevailing narratives has been like Bitcoin is seeing institutional adoption. Like banks are getting in, like Elon's getting in, whatever. Like all these people who are like predominantly going to be buying spot Bitcoin and not derivatives have been entering the market. And yeah, so that's been another effect in the same direction. Where like the high leverage contracts are becoming less important, and the lower leverage or spot contracts are becoming more important in terms of like actual like long term net flow that's driving the price of Bitcoin longer term. Um, but yeah, so I definitely think that's been going on in terms of like the recent move. Um, it hasn't like it's sort of just been a part of the same kind of longer term trend where we're seeing inflows not on the BitMEX Bitcoin perpetuals anymore or the Binance perpetuals. We are still seeing that, of course, and the Binance perpetuals are quite important. But like this move, I think had like less of that than previous moves, and I think that's sort of just a trend we're going to keep seeing.
Right. Okay. Right. Let's talk about your call, your 29K call, 10
Mhm.
minutes before it started pumping up.
Yeah,
Was that so?
that was
So,
that was
Danny,
cool.
yeah. So, Danny sent me the tweet and he was like, yeah, you got to ask him about this. Did you just get lucky on the moment or did you have a real kind of gut feel? Like, did you know it was coming that soon?
I certainly did not know it was coming within 10 minutes. That like the trade I was talking about there was sort of like a days long thing that I was thinking. Uh, so I mean, the reason, so like when Bitcoin fell to 30K or 29K or whatever, uh, it so like there were a few reasons why it seemed like fairly likely to revert on like some time scale. The main reasoning being so we were sort of in a we sort of still are in a paradigm where I think the market reacts super strongly to news, where news can mean like a variety of different things. News can be like a tweet from Elon Musk saying that he is like buying Bitcoin, or is like now he's on Doge because Bitcoin sucks, or like a few weeks later, like oh no, Bitcoin's fine again as long as it fixes these two things. So like that can be news. But there can be other news, like China has a lot of news come out pretty routinely. Like a few weeks ago, we were seeing like various stories about like oh now China's banning Bitcoin again, and then like oh like never mind, it's actually only like restricting leverage on a few platforms, and like there's still a lack of clarity coming out of China, but this constitutes news as well, and like the U.S. has news, like all these like the market reacts to like all kinds of things these days. But in my opinion, and this like the math sort of bears this out, the market overreacts to news like most times. And the way you can see that is that the market will like move in a certain direction, like generally the predictable direction. Like if news reads as obviously good, it will go up. Um, but in general, like over like the hours after the market reacts to news like that, it will go the opposite direction, like for like some fraction of the move. Um, so like if Bitcoin goes down because of bad China news, it will generally like go down X% and then go back up X over 2% or something like that. So it always like reverts part of its moves. And the dip to 29K was sort of part of that pattern. It had fallen like there had been like sort of a barrage of like things the market obviously viewed as bad, and like whether or not they actually were bad. Like again, I'm not really the guy to tell you. I can tell you what people think, but not really like much about the fundamentals. But yeah, the market dipped to 29K off of the back of this, and another exacerbating thing was this sort of liquidation effect again. Like on the way down, there were a lot of levered logs getting liquidated, and on March 12th, we saw the dip to below 4K revert quite fast because, like I said, no one wanted to sell below 4K. The second it got below 4K and people were able to start buying, they were really excited to. And I sort of figured something similar was going to happen with 29K because it's much less extreme. Like there were organic sellers because of the news, maybe down to 33 or 34K. But there were a lot of liquidations that drove it down to 29. And yeah, it just sort of seemed like so much of the net outflows were either inorganic because of liquidations or rife like ready to revert because they were because of news that I'd seen revert a million times before. And yeah, so it seemed quite likely that 29 was too low and it was going to revert. I did not think it was going to happen within 10 minutes. I was thinking more 6 hours or a day or something. But yeah, no complaints. It certainly
Quite,
made me look smart.
it was quite the call. Yeah, I've got a couple of questions on news and sentiment as well, because it feels to me, as somebody following the price, that sentiment or news seems to track to momentum. So during the kind of dip from from 64 to 29, we had the news of El Salvador coming out, which was quite bullish news of a country accepting Bitcoin as legal tender, and there was very little movement in the price. Whereas I think if this had come out maybe at like 62, we might have seen another leg up. So it seems to me like it's like there's a certain correlation between news and momentum. And another thing I did notice is back to what you were saying. I remember when Elon Musk announced that Tesla would be accepting Bitcoin as a payment, and the it shot up like 3 or 4K, and probably like within 2 hours it came back down. It was a real kind of
Yep.
Bart Simpson pattern. So I guess as a quant trader, this would be useful for short-term trades, but really people should not overreact too much to news.
Yeah, I mean, I think in general, yeah, just like looking into what sort of the impacts of news in the past has been, not the immediate impact. It's really important to look at like what the net impact over the next day was from these like sort of big news items that you'll sometimes see, and like yeah, like for the initial couple Elon Musk tweets, it was kind of hard because we hadn't seen anything exactly like that before, um, but yeah, like just sort of like a sanity check, like did like yeah, should Bitcoin have moved up 4K off of this one piece of info from Elon Musk? That like, yes, it was an update, but like, was it this big of an update? Like, it should be like, I just think yeah, applying a sanity check like that is generally a good idea. I mean, for what it's worth, on some level, it's still that doesn't exactly matter. Really, really short term. So one strategy Alameda now uses is we alert or like we have a bot that's always looking for Elon's tweets, and if we believe that we've caught something within like 5 seconds, we will be willing to like bet pretty big on it, even if Bitcoin's already moved a little bit. We'll still be willing to like keep going in the same direction if we think that we've beaten like a high enough fraction of the market to knowing about it. So like really short term, it doesn't matter. But if we put on a trade like that, we will try and exit it pretty quickly, just in general, because yeah, like the Elon effect has really changed a lot in that like there is like a big move right away, but it reverts within like a minute these days.
That's interesting, because if you're reacting within 5 seconds, you always have to make a decision whether that's positive or negative news as well.
Yeah, we tried to write a bot to do that, but it turns out sentiment analysis by computers is still not exactly perfect, especially when Elon's tweets are not always text even. They're sometimes just like a picture of a dog on a spaceship, and you have to decide if that's good or not for whatever.
So is there a person who's literally sat there waiting for the alert, and they're ready to click and within 5 seconds make a decision?
It's a Slack channel, but yeah, we our traders will be watching it.
That's amazing. Okay, another thing I wanted to ask you about was sometimes you see Bitcoin, say, paint a 2, 3, 4K candle pretty quickly. But my understanding, if somebody's going into the market to buy a large amount of Bitcoin, they'll usually go through an OTC desk, and they will be trying to buy small little increments for a couple of reasons. One, to get the best price, but also, especially if you're buying $1 billion worth, you don't want to signal to the market you're buying $1 billion worth. You want to be quite clever. So when we do see these big candles painted, what is going on here? And I know there's probably a much more complicated answer, but I don't understand, therefore, is that somebody who is fat fingering a $100 million, $200 million dollar buy, or is there something else going on?
Yeah, so it's definitely there's a few things that can be going on, and I don't exactly know. It's
Mhm.
because like Alameda has never done this, so I'm not exactly sure about like what people's reasoning is when they're doing this. But yeah, like you'll sometimes see things like that in the wake of news, where like maybe someone thinks they only have a minute to respond to this, and they think there's going to be big impact, so they sort of have to send what amounts to a market order to buy a lot or whatever. So that's like one possible explanation sometimes. But like you see it all the time, and so it's not. This isn't like the only thing going on. One thing that can be going on is it can be the it can be like one of the liquidation market buys or sales that I talked about before, where it's not exactly the person doing it, but it's the exchange doing it. Um, that's something that we see sometimes, and it looks identically to what you described. Sometimes it's going to be someone who doesn't really understand trading very well, or who doesn't have access to the kind of liquidity that you're talking about, and who also doesn't like write bots to do this in a more intelligent way. Um, but yeah, I don't have a very satisfying answer to this
No,
insofar as like I agree that it's kind of a crazy thing that no one should ever do, but I agree that people do it.
but also, I guess one of those ones that can paint up and paint down very quickly. Could that also be a scenario like you guys? You've seen an Elon tweet, you've reacted, you've done the buy, and then maybe you've reconsidered and thought, actually, we should get out of this one. Could it be that kind of scenario as well?
It could. So that's not going to be what we do in general. When if I like see an Elon tweet and I want to buy, the way that our automated bots work is a little more complex, I think, insofar as like I don't tell the bot, "Hey, go buy a ton of Bitcoin on Binance." I tell the bot I want to get long Bitcoin, and the bot sort of splits the order up for me across every Bitcoin market in order
Okay.
to like get better pricing. But yeah, the kind of thing you're describing is definitely possible more globally.
Okay, so look, we went down to 29k. That was the first time I bought since myself since I think 37k. So when we were up near 64, I didn't. When we were down at 29k, I didn't buy exactly at 29. I actually bought when we were up to about 32. It's the first one I'd done in ages. And one of the reasons I bought is because there was so much negative sentiment. It felt like 30k was being defended quite well as a price. Yet there was so much negative sentiment calling for like 20k, and it felt like a drop down to 20k would have been like a unique scenario mid bull market. So me, like, and this is really just gut feel, like in the air, fuck it, let's go with it. It felt like a bullish time because everyone was so negative. Do you ever find that like when the market's super negative, actually that is a time to be bullish?
It it's definitely like the sort of signal you're talking about is definitely like a real thing. I think where if like especially around with round numbers, there can be like this very distinctive behavior around round numbers in crypto. Uh, so as a way earlier example of something similar, when like last winter when Bitcoin like hadn't cracked 20k yet, but was like it kept getting up to 20k like over and over again, and sort of going right back down, or at least like not, a little bit at least. Uh, uh, like the thing going on was that there was like a ton of resistance to Bitcoin getting above 20k. There were a ton of people who were like, "Oh, Bitcoin's never going to get above 20k." Like I've been around for 3 years and it hasn't. And so like they're like selling Bitcoin like at 20k because they believe that it's not going to get above 20k. But Bitcoin sort of stayed right under 20k forever, and it kept testing it, as people will say.
I
Um,
remember.
but it never like got above 20k. And the fact that it didn't get much below 20k, even though there was obviously so much resistance below 20k, was sort of like a pretty strong signal that like oh like if it ever does get above 20k, it's going to go way above 20k because all of these resistance sales are happening exactly at 20k. If it gets above it, if it gets 21, it's probably going to go to 25 very quickly, which is like actually exactly what happened. And uh, the reason that I think that this effect is not what was happening, or not what like sort of ended up happening, like around 30k, is that like the lead up to 20k was like the thing going on for years. There were a ton of people who were super excited to be buying. The sentiment was like obviously like a lot stronger, I think, at least on the buying side, than it was on the selling side most recently, like getting below 30. And so that's what I think is like the big difference between these two situations. But yeah, thinking really hard about the actual effects and like what people are doing around round numbers has like is sort of like more important than it maybe ought to be, and more important than it is in traditional markets, where which are like less because crypto and the Bitcoin market are like so much more immature, I guess, and like these sort of like level one analyses of like oh like what are people thinking around like 30k, like these actually do matter quite a bit.
Well, 100k. I mean, what are you thinking around? Because I keep thinking in my head, 100k is going to be a it's going to be a massive number, a bit like a 1K was, a bit like 10K was, although as I remember, 10K we shot straight through. But 100K, I'm thinking that is a massive number. That's going to be a number a lot of people are going to be thinking about. So perhaps people are going to be trying to, be one step ahead and be selling at 95. Well, if people are thinking like that, well, perhaps it'll be 90. Like, I'm in this kind of like psychological game in my head thinking about how
Right.
people would play it. Is it something you're, well, I guess you are thinking about it.
Yeah, I mean, one thing I would say is that I think that most times I've tried to play psychological games like that in crypto trading have gone badly, I guess. Insofar as I often find that the level one explanation ends up just sort of being the correct one. An example might be it's pretty well known that or like not well known, but like a common mantra in crypto trading world is to buy the rumor, sell the news. Um, like when the Bitcoin halvening, for instance, is a good example where people are talking about the halvening a lot, and sort of the conventional wisdom, for all of these events, is always like, oh, like it's going to rally going into it, and if you think about it, like if I know that, if I'm like a trader who knows every time there's any event, you're supposed to buy into it, and then sell the event itself. I should just buy before that. I should maybe buy 2 months before the event because everyone knew when it was going to happen. But it still happened. The rally into the event still did happen, and it happened again. With the ETH London fork, and yeah, if you level yourself with these things, you're gonna buy way before the event and not in the weeks leading up. But you still are, I guess, supposed to buy in the weeks leading up because the level one explanation is still right. So I would advise against leveling yourself on the maybe I'll sell 90K because the market's gonna try and do that. Leveling doesn't work in crypto, and yeah.
Well, that's one of the things I thought maybe happened during this bull market, because I think we got up to 60K, and everyone was so bullish, and people saying no, it's going to go to 70, and then we're going to 100, and people saying we're going to go 300K this bull market, and people were looking at the charts from 2017, and it was kind of very similar, a few 30% dips, but we're definitely not going to see a 50% dip because that didn't happen in 2017. And I felt like, well, was that what happened? Was it too many people leveraged up, too many people thinking the same was going to happen, and add in a little bit of negative news, and we get the rug pulled from us essentially?
Yeah, the rally up to the most recent peaks in the 60s, that is we saw a lot of leverage leading the way there, and so it's not guaranteed in general that a move that's led by a lot of leverage is going to revert or anything. But the effect that does happen is that let's say a ton of leverage, there was a lot of leverage the entire way up, and let's say to 65K. If let's say that I put on a huge leverage position at every point basically. So I did that at 50K, I did that at 55, at 60. If the market never dips, great. I've sort of just made money all across the board, and nothing bad will ever happen to me. I've just sort of have made a bunch of money, and I can close the positions when I feel like it. If the market does dip at all, let's say the market just dips down to 60K for a bit, and again, I'm using really high leverage. Some of my positions are gonna get liquidated now, and yeah, this is sort of just what ended up happening. The market dipped a little bit, and then the market had to dip a lot because so many people had gotten so much leverage at high levels, and so yeah, I think that's a lot of what ended up happening.
And so people panicked and sold, and therefore it created that cascading effect. Some got out, some didn't.
Yeah, I'm not gonna claim why the initial dip happened, but yes, I think that is basically what happened once the initial dip happened.
Wow. So looking now, I mean, 29K certainly for people who are new to Bitcoin was quite scary. Haven't been up so high, 64. Somebody who's been through a couple of bull markets, seen this before. I was still a bit like, meh, this is fine, whatever. But we are now back up. I just had a look. I think we just hit about 46.5. Again, this feels
really?
I think 46,600 maybe when
we
were talking. Yeah.
You miss a lot in an hour. Yeah,
I know, man. It's wild. I've had it before when I've been on I had it once when I was on a plane, and I bought a watch before I got on a plane in 2017. feeling like confident because the market was great, and we 30% dipped, and that was pre-Wi-Fi and British Airways. So I get off the plane and we've 30% dipped, and I've lost the cost of my watch. But
Yeah.
it feels like this move up again. It feels like it's quite a strong move up. But what's your sentiment about where we are? Are you like super bullish? Are you guarded bullish?
Yeah. So I agree. In the like with the it's been a strong move up sentiment on some level. Insofar as yeah, again, the leverage has been lower of the new of new contracts that are being opened. Like a lot more of it is in like the spot markets. Like yeah, we've seen like the open interest of like various like spot borrowing platforms. Like the amount being borrowed is like of like USD has gone up a lot in the past like month or few weeks or something. And so yeah, that this sort of just suggests that like people are like more of the buying that's happening right now is happening on these markets that are less likely to get liquidated if there's a small dip. And so yeah, like in that sense, I agree that the buying right now is like stronger or less likely to get completely undone than like what sent us above 60K last time. Um, in terms of like what I'm expecting short term, like yeah, I mean, I it's kind of hard to say right now. The I think that uh, I think that like the spotlight that has been on crypto has like in the U.S. for instance over the past few days with with the amendments to this bill that have been being like pretty heavily discussed. I think it's easy to miss the forest for the trees in thinking about that. Like yes, like oh, like the specifics of like which of these amendments is going to pass. Uh, like is this going to be like which set of coins is this going to be like terrible for like whatever. Like yes, like these matter. But like I think the important thing here is like the U.S. government is talking about crypto in a way that like is actually just dominating the news on some level.
Mm.
Like I'm very tuned into like crypto news, so like I like when something like this happens, I always hear about it. But I sort of looked at like a regular news source, and like it is actually what people are talking about right now, and it's not in an especially negative way. It's like the work being done in Washington has seemed to me to be like actually like looking for solutions on some level in a way that Washington isn't always, and in a way that I guess I wasn't naively expecting this to go. And so yeah, I think that it's been pretty exciting just to be like, yeah, like crypto's like actually like gaining traction in the world. In like obviously we knew that like we've it's been the narrative for the past few years, but yeah, this was kind of revelatory for me. So yeah, it wouldn't surprise me to see things like that keep happening. And if things like that do keep happening, I think we'll see the price sort of start to reflect that in a way that I think has happened over the past few days. Like I think this is like a lot of why Bitcoin's up right now. And if things like this keep happening, we'll probably keep seeing that.
Well, something Willie said to me when I spoke to him a couple of weeks ago. Obviously, I mean, I don't know what your views are on on-chain analysis. I think it's a tool. I don't think it's a crystal ball, but I think it's a tool and can be a useful tool amongst a massive armory of things that you can use as a trader. But he said one of the interesting things is that what he considers retail buyers to be a bit of a hockey stick at the moment, still going up. So despite everything else, the retail buyers are coming in and still buying and still buying. And he says to me, retail buyers drive bull markets as well. I mean, I don't know if you have any opinion on what he said there.
I mean, sure. Like basically any effect that can create like net buying or selling will tend to drive the market. And yeah, so like in the like to the extent that it is true that retail buying is like mostly going up, yeah, that will drive the market. Like retail buying, like or the retail market like is like a fairly big can be like a fairly big like net amount of what's going on, and yeah, so I definitely think that that's like probably a piece of what's going on, just given that the market has been going up. Um, in terms of like the on-chain metrics, I think that people, yeah, like you said, I think that people tend to read into this quite a bit more than they ought to. Like something that I see on Twitter a lot is like, oh, like look at all these bitcoins that like net went into like exchange X. Uh, like this is terrible. Like Bitcoin's going to go down because the only reason people might like probably that means people are going to sell it, right? Uh, like one I've almost every time I've looked into a claim like this, it has been the exchange moving between two wallets. and like one of the wallets was not labeled correctly, and this
Yeah.
is sort of almost always what's going on. But two, like what if someone's moving Bitcoin onto the exchange to use as leverage for a long position? Like you don't know, and yeah, so I agree that it can be a tool, um, but it's a very weak signal. Though, yeah, I agree that like there are rare cases where these things are worth knowing about.
Right. Listen, I've got two final questions for you, and thanks again for coming on. I really appreciate this, and Danny will be happy. But one question you're going to hate, but basically I'm going to ask it anyway, is how far do you think we can go in this cycle? Because it must be something you're considering, like how far do we go? But an almost a more important question is, and yeah, something I kind of want us to break out of this 4 year cycles that we're having, because I don't know if the 4 year cycle is real. It's the reflection of this S2F model, or it's just like a self fulfilling prophecy because everyone expects it. I hope we break out of it. I'd like to see the market to mature beyond having those 4 year cycles, because I don't like the 60-70% drawdowns. I don't think they're good for everyone, and they're good for people who understand how to trade it, but I don't think they're good for everyone. So yeah, how far do you think we can go, and do you think we can break out these 4 year cycles?
In terms of how far it could go, I guess I would say that uh, like it wouldn't surprise me at all for Bitcoin to start getting into the 100K range. I'm not claiming that I think it is, to be clear, but it wouldn't surprise me at all. And a big part of the reason why is that like while we are getting away from this high leverage regime, we're not like fully away from the high leverage regime. And like supposing that Bitcoin gets to like 70K or 75K, that's a level that we've never seen before. And there's like a bunch of like longer term short positions that have never had a chance to get liquidated before that like could get liquidated if we hit that level. And so like if we start hitting these new like high levels, uh, people who have been short for a while or who are like are newly short or whatever are just going to have new chances to get liquidated up, and that can like so there's like some chance that there's like all this. In addition to like organic buying, there might be a bunch of like inorganic buying that like sort of shoots us up there more quickly than we would otherwise. Uh, and yeah, so like that's something I wouldn't be surprised to see. I think that if we do start getting around 100K, we will sort of see a similar thing to what we saw around 20K the first time, with like a lot of resistance, like you mentioned. Um, and so yeah, I think it would take like something at least like a priori a bit surprising to me to get above 100K, just because there will be resistance there. It's just like impossible to imagine there won't be. But yeah, it wouldn't like if we start testing it, it wouldn't surprise me. In terms of the 4 year cycle thing, I think that there have not been a ton of 4 year periods from which to draw the conclusion that that's actually what's going on. I guess
Yeah.
I yeah I know that people like it's like a quite prevailing narrative, but like it's crypto's been a thing for or like a popular thing for like not very many years, and so I think that yeah claims that like every 4 years this sort of thing is going to keep happening are like not especially data driven in my opinion.
All right, man. Well, look, this was great. Love chatting to you. Yeah, awesome. And I think Danny's going to be, he's over in Australia, but he'll be up, and this is the first thing he's going to listen to. So
Hope
thanks to
so.
Danny for pushing me to this. But look, also congratulations on everything I made her, and your new role there. That's very cool. And hopefully sometime we'll get to do this again. I really enjoyed it. If people want to follow you, do you want to tell them where's the best place to find you?
Yeah, my Twitter is Alameda Trabucco. That's ALAMEDA TRABUCCO.
All right, great.
And
I'll
yeah,
stick it in the show notes.
cool. Thank you.
Thank you, man. Take care, and I will see you soon.
Yeah, bye. It's great talking to you.